Saludamos a Jay Pelosky, es fundador principal de TPW Advisory. Thank you so much, Jay, for having us a few minutes.
Nice to speak with you, Marta. Good evening.
Jay, Fitch has cut its global GDP forecast growth for this year due to inflation challenges and war in Ukraine. And Fitch now expects US CPI inflation to peak at 9%, an average of 7% for the year as a whole. How do you see these new projections?
Well, I think the inflation number is going to be way too high. It looks to me more like we are approaching the peak in U.S. inflation, in part because of the base effects. Last spring was a period of high inflation also, so as those numbers fall out of the year-over-year comparison, the inflation number should come down. I expect by the summer we'll be looking at 5% or 4% inflation in the United States, working our way towards 3 to 4% by the end of this year, first half of next year. And on the growth side, I think the expectations for what people are calling stagflation are very off base. The way, from what we can tell, consensus GDP for the United States this year is 3.5%. In the ECB for Europe, just projected 3.7% for European growth in 2022. And that compares to pre-COVID average growth rates of roughly 2% for both the US and Europe. So growth is going to be well above pre-COVID trend levels.
Jay, Powell said that if the Fed needs to raise funds by more than 25 basic points at a meeting or meetings more fastly, they will do. And meanwhile, we've seen how Atlanta Fed's president Rafael Bostic sees 6 rate hikes this year and 2 for next year. This is fewer than most of his colleagues, as he worries about the effects of Russia's invasion of Ukraine on the US economy. Which of the two outlooks do you see most accurate?
Well, I think, Marta, thank you for asking, but I think more importantly, what the Fed did last week was to kind of align itself with the market. And so remember that the Fed did not have a February meeting, and so had not met since late January. And obviously in between late January and today, we had the Russian invasion of the Ukraine, which led to sharply higher energy and food prices. And so importantly, the Fed, it was a mark-to-market meeting for the Fed. And their expectations, consensus expectations within the Fed of 6 more rate hikes this year fits perfectly with what the market is expecting. And so to me, where the surprise was in the Fed's comments was in their growth forecast, where they forecast GDP to be 2.8%, well below the consensus I just spoke of about 3.5%. So that's kind of interesting. It would suggest that if they really expect growth to be around 3%, then 6 rate hikes should be more than sufficient. So to me, most important was the Fed and the market are now aligned. That should reduce bond volatility. My own view has been and continues to be that the Fed will raise rates maybe 2 or 3 times this year. So they've already done it once. So another 2 hikes, and then I think the Fed is going to pause and kind of assess the success and where inflation is. I expect inflation in the U.S. to be much less of a concern, let's say, in 4 to 6 months than it is today.
This is the outlook for United States. In Europe, Bundesbank President Nagel said that the ECB should raise interest rates if the price outlook required it and if bond buying ends in Q3 as now planned. Nagel said the risks of tightening policy too late have increased. Which are the main risks, Jay? And do you see really a rate hike at the end of the year in Europe?
I do not, Marta. I don't expect the ECB to be particularly aggressive. Keep in mind that the big bulk of the inflation pickup in Europe is because of energy prices. And as we've seen, energy prices have already fallen considerably in Europe, at least at the forward market kind of analysis. If you look at, for example, the benchmark natural gas contract, the Dutch natural gas contract, it's fallen 70% from its peak of a month or so ago. It was down 50% in the last 5 days. So again, I would expect that should we move to some sort of resolution on the Ukraine, which I expect in the near term, then I think energy prices will calm down considerably, and the inflation concerns that people have in Europe will likewise calm down considerably, and therefore I think the ECB is going to be quite cautious about raising rates. But much as in the United States, the market is raising rates for the ECB. The 10-year German Bund today is trading over 40 basis points. That was minus 25 basis points pre the invasion. So the market is already kind of doing the work for the ECB, much as we've seen in the US, where 2-year interest rates are at roughly 2%, up well over 150 basis points since the start of the year. Markets are moving faster than the policymakers. So when the policymakers move, it doesn't have the same effect as it might have in prior periods.
Christine Lagarde said she's not seeing elements of stagflation now. Do we believe that? Because too many voices started to warn about that.
Yes, I mean, a lot of people are talking about stagflation. I think it's actually very lazy thinking, because stagflation requires inflation, which, arguably we have. It also requires quite low growth, which we do not have. If you look at the city economic surprise indices, if you look at the PMIs, if you look at the labor reports, the unemployment rate in Europe is at a record low, close to a record low in the United States. Retail sales are strong in the United States, strong in Europe. China is easing. Asia is coming out of the COVID lockdowns. I think I expect over the next couple of quarters that the ending of COVID lockdowns and the ebbing of COVID as a pandemic is going to be much more important for growth and much more important for inflation in terms of reducing supply chain worries than the Russian invasion. I think Russia's invasion has taken people's eye off the fact that COVID is ebbing. And that, to me, is on a global basis a much more significant event than Russia's invasion of Ukraine in economic terms.
And finally, Jay, considering the current market scenario, whether you see investment opportunities?
Well, I think, Marta, there's a lot of investment opportunities, and I do not share the negative outlook that many people have regarding stock markets around the world. I think Europe is a very attractive opportunity right now. European equities, European banks should be beneficiaries of this backup in interest rates we just spoke of. I think thematic stocks in the United States, the disruptive tech, the climate type stocks are very attractive. I think China, last week, China's government came out with a very full-throated support of financial markets, both in China and in the West. I think that
Parece que justo
laid out.
Thank you so much, Jay, for this analysis of the current situation. Thank you so much.
It was a pleasure, Marta. Look forward to speaking with you soon. Bye-bye.